today a little bit about what I do as well as how to invest in out-of-state real estate. But before we get started, I would like to have an understanding here of who here owns out-of-state real estate? Awesome. Who here has lost money on out-of-state real estate? Wow, that's a lot more hands. So it takes quite a bit to get started doing that. And so I'm going to talk a lot about that today, and hopefully I add some value. And I'd love to be able to keep this a Q&A types event. So if you have questions, please feel free to ask those questions. We don't make any money at this club. We pretty much break even at all of our clubs, and so we bring in different sponsors for people that we do business with in the real estate arena. A lot of this comes down to team members and who you can rely on to help you with. I'll go through those. Tiffany and I run this group here. Just a little bit more about FIBI. Tiffany and I run this group. We've been running it since 2008. So I quit my CPA firm job in 2006. So like I tell people, for those of you guys who've heard this before, I quit and was a real estate genius for about a year, and I got slapped in the face really hard, which was probably the best thing that could have ever happened to me, to be honest. So I'll have to tell you a little bit about it later on if I talk to you in private, but it was a fun experience. I had an office at the World Trade Center in Long Beach on the 23rd floor, spending $5 grand a month on an office, quitting my CPA firm job, going, "You're an idiot. You're spending so much money on overhead right now," and you realize really quickly when the market tanks that you don't have any income if the market tanks all of a sudden. You're relying on banks. So you have some fun experiences along the way to look forward to if you're just getting started. But I can tell you, those experiences will give you the education you need to actually succeed in this business. Since that happened, I flipped over 500 houses with my team. We invest in multifamily buildings, we invest in syndications, we own a management company and a renovation company and a brokerage on the ground out in Tennessee. We do a ton of different stuff and we help a lot of investors out with their cash flow strategies, with their investment strategies, not even relating to my business, but just helping people, because I really feel the more we educate each other on this and bring different experiences to the table, the more money we can make together, because we want to look at this as a team. None of us have the resources to do this ourselves. We all need each other to help each other out in doing this. So that's kind of FIBI's philosophy. So this is our meetup group, which you guys RSVP through. We also have some annual passes if you're interested in doing that. So $199 for an annual pass to come if you like the stuff. Like I said, we're just trying to basically pay for the overhead and the insurance and all that stuff. We don't make any money doing this. We have some upcoming events coming up. We have a brunch and learn on April 8th on investing in promissory notes. I also co-run the FIBI Manhattan Beach or South Bay. It's actually now in El Segundo. We just moved venues. And we're going to be talking about, we have more of a panel discussion at that group, and talking about how to create sustainable cash flow through promissory notes. And so that's another strategy to invest in real estate that's collateralized by real estate, so you can have some security involved in investing. So it's very, very important to learn the different strategies that are involved within real estate and add those different tools to your tool belt. We have a webinar coming up on April 19th to secure your financial future, invest in real estate through self-directed IRAs. And then we have next month here, we have an attorney coming in to talk about probate deals and how to find them. A very, very educated guy that's coming in to talk about those. So here's our sponsors. First, Trillion Capital. Mike, you want to come up real quick? Thank you, sir. Trillion is a private money lender. It helps flippers.
Good evening, everyone. Welcome to the group. If you've never been here before, it's a really great opportunity of all the groups.
Thanks.
I go to a lot of groups. This is really informative one, FIBI in general. There's more than one chapter, so you can always go to all the different chapters. And it's just a really great resource. Trillion Capital is a hard money lender. We specialize in lending to fix and flip investors. So if any of you are interested in that, we provide hard money first trust deeds to help you purchase those properties. Some things we can do to help you out is we work with everything from first timers to very experienced. funds to help with your offers, to get those offers accepted. And I can also give you like a second look at the deal, whether or not we think you're going to make money or not. So it's just a second set of eyes looking at your deal. We only want to lend on properties that we think are going to be successful. If we think, especially for like a first timer, if you feel like you're in over your head, the numbers aren't really working, we'll sit down and talk to you and kind of work through, why you think you're going to make money versus why we think you aren't going to make money, and hopefully guide you in the right direction along those lines. So, in any event, I've got flyers at the table, and if any of you have any questions about the business, please give me a call. Thank you.
The reason I like Mike is because he will go through and their firm will show you what not to do. That's what you really want in a private lender. Someone that will come in and tell you, hey, this is a bad deal, don't do it, you're going to lose money. If they won't fund the deal, then that means that there's something wrong with it. So be very, very careful, especially right now with the margins that you're seeing out here in California. I mean, you're looking at like 8% margins if you're lucky. So I personally will not flip a house unless you make at least 10% margin on your money. Okay? So keep that in mind when you're flipping, especially with the volatility in this market. So be very careful when you're flipping. So we also have a couple other sponsors, OCG Properties, which is my company. LQ Financial Services is probably the best bookkeeping company you'll ever see in your life, and mostly because it's my wife's company. So I have to say that. Anyways, Hart King, come on up.
I'll just stay here.
Okay, so Ron,
Thanks. Bill Hart, Hart King, 35 years, real estate attorneys here in Southern California. We have a group within our firm that specializes in advising buyers, sellers, managers, brokers, in all things real estate. So Matt asked me very kindly to be here. I'm happy to answer questions. We've helped Matt in a number of matters that on an ongoing basis, and we look forward to continue to do so. Very, very knowledgeable guy. Listen carefully to everything he says, because really he will save you a lot of time and money. So we're proud to be working with him, and look forward to talking to you if you have a question. Thanks very much.
Thanks, Bill. He's cleaned me up quite a bit on some of my legal matters, just making sure you plug the liability holes in the company. So, in-a-day development actually is Tiffany, the person that co-runs this group with me. She actually, her husband runs in-a-day development. They actually have a financial calculator app that I use every day for seller financing transactions. It's one of the most awesome apps. It's called the 10BII Financial Calculator. I mean, it's like $6 when those financial calculators are like 50 to 60 to buy them. So, and you have it on your phone, which is way easier. And you can actually go and print out the amortization schedules, all that stuff. Everything a CPA like myself just loves. You know the numbers involved in this stuff. So we have a sponsor, UDirect. Jeff?
Yeah, hi, I'm Jeff Dixon with UDirect IRA Services. We are a self-directed IRA firm, and what that means is we help our clients who want to invest their IRAs or solo Ks into alternative assets that are outside of the stock market. You can hold real estate, make loans, buy notes, precious metals, invest in private companies. There's a number of things you can do with an IRA, but you have to have a company that allows you to do it. And we're such a company, and I'd be happy to help anybody that has questions about it. Thanks.
One of the best strategies to utilize.
And one other thing, just real quick. If you're interested in meetings like, or not like this specifically, but there is a real estate expo that's next month on the 28th in Orange County. I actually have flyers on the back table there. If you have any interest in it, it's an all-day event. Number of different speakers will be there. Might be worth your time. Thank you.
Thanks.
Yeah.
I use self-directed retirement accounts substantially in my business. We've flipped properties slowly inside of your 401k and IRA. The reason I say slowly is because if you're actively running a business inside of your IRA or 401k, you can get hit with a tax. It's basically an unrelated business income tax. So we wait a year and a day to go sell those properties. That's why I say it's a slow flip inside your IRA, so be careful with that aspect. New Western. Okay, there we go. Cool.
Hi, I'm Zach. I'm here from New Western. We're one of the newer sponsors, so new we didn't get one of the cool names.
You'll be here soon.
Yeah, soon. We're a wholesale investment brokerage. Local, we have offices in Corona, Eagle Rock, and we have one in Orange, but that's actually relocating to Long Beach here shortly in the next few months. We've created kind of a unique platform for a lot of different types of investors, whether you're a wholesaler or you're a local flipper. Some of our clients are like the biggest flippers in town on that side, and also some of the biggest wholesalers. So if you, I don't want to spend too much time on it, but we're doing a lot of deals. So if you're looking for flips, we're a good person, a good team to get in touch with. If you're a wholesaler looking for a deal, you don't really have buyers, we're a great person to get in touch with. So if you guys have any questions, feel free to contact me or come talk to me about it.
I signed up as one of your guys' flippers, and I've been getting deals every single week from them, which is cool because sometimes they work for me, sometimes they don't. But I think I just sent one to Deck the other day saying, hey, let me know when you guys are going to do showings for this one, because it looked like a good deal. So, but it's cool to be able to have deals coming to your door consistently that you can analyze. I met the owner of the community buying group and a mastermind group that I belong to that actually has, what they do is they combine resources of tons of other investors to be able to come in and help you save money on some of the main services you get. Like Sherwin-Williams, for example, they get like 24% discounts at Sherwin-Williams. It saved me a ton on my flip, or on my primary residence that I'm building right now. They have, so these are the different ones, which is hard to see right here. Build Assign 20%, Dell 30%, Hertz 40%. So, there's a ton of these things out here that all relate to real estate in one way, shape, or form. Simply Safe we use for our rental properties consistently. So there's a lot of these things. If you go to cbgperks.com/OCG226, you will be able to access all these savings if you want them for your business. So just wanted to let you guys know about it. So we also have a ocgproperties.com/en for English/networking. If you guys have resources or tools that you can provide to other people, or if you're looking for relationships from other people, like an attorney or a CPA or some professional in your life, let us know. You can put your information in there and say what you're looking for, and we'll try to match you with the people that we know that we work with. So Rick, where's Rick at? Where'd he go? Oh, he's in the back, hiding in the back over there. Okay. So he hooked this up to where, because we wanted to be able to find a way to add more value to people in the room. So and provide more resources and tools for people to be successful. So that's it for that aspect of it. I'm going to go ahead and close this off, and then we'll get into the educational part. Thank you guys very much for your patience. Okay, see if I can do this. Okay, so of those of you guys who invested in out of state, what were the problems you guys saw? Anybody? Yes?
Finding a good property manager.
Absolutely, the most imperative part of investing in out of state is finding a good property manager. I'd say that's probably second to not buying in the hood. I bought a lot of properties in the hood in the very beginning, and learned lots of fun lessons, including rehabbing a property 3 times because the neighborhood knew about it before I did. If you're flipping, it can be a good deal, especially like out here in California. You might be able to find a homeowner and things like that that is interested in that. But in certain out-of-state markets, you're going to be really, really careful where you buy. In the very beginning, when I first started going out to Memphis, Tennessee, I had a property manager drive me around during the day on a weekday versus at night on a weekend, which you see all the foot traffic, and you see the crackheads, and that's exactly what I saw right after a property I just bought. I'm like, oh, great. This one's going to be fun to deal with. So I'm not trying to scare you guys, but at the same time, if you're investing out of state, you really have to do your homework up front. You really need to understand the neighborhoods in a lot of detail, talk to people that are not involved in the transaction that you're doing business with, that don't have a vested interest in that deal. Make sure you do your homework on that side of things. Make sure you understand what the tenant lease looks like. You know, for example, I don't rent to Section 8 tenants, even though I'm not supposed to not do that. And the reason is because they're judgment proof. If I had a Section 8 tenant come in, and great, I get rent from the government. It's awesome to be able to get, you know, consistent rent coming in. But at the same time, if they move out, you can't get them for anything. They don't have any money. They don't have income to go after. So there's a big challenge with that aspect of things when you're trying to look at it from an investor perspective. And I find it's much better to find higher end assets that have a quality tenant already that can make 3 times the income, that have a good job, that if they mess up your house, you can actually go after them for the money. So very important when you're looking at out of state. There's a lot of problems to look at when you're dealing with that. So a little bit about us. I'm a CPA. I went to UC Santa Barbara. It was a lot of fun. That's all I'll admit, from Santa Barbara. I went there because it was between that and Pepperdine had hills, and Santa Barbara had parties. So I was going there for the parties, is what I thought, at least, until I had to go to the library when my friends were partying during Gen Week. So that was lots of fun to deal with. I flipped over 500 houses. We flip 5 to 10 houses a month right now. We own and manage over 200 properties right now out of the Memphis market. We own a brokerage and a property management company. And I came from the CPA world, where I worked a lot on real estate clients for CPA firms, where I would help them do audits on their multifamily buildings. And I got to travel to different markets around the country to look at their buildings, understand this company specifically got government subsidy for retirement communities, for people with low income that are elderly, and so they had to have audits from the government in order to get that money. And so I got to go in and review all the paperwork and understand. I wish I knew what the heck I was looking at, you know, then compared to now, because it would have been a hell of a lot more educational if I had some real estate experience then looking at those numbers. But I can tell you, getting the understanding of the underlying numbers involved in every transaction can really set you far apart from anyone else in this business. And understanding what numbers, what assumptions should be made. Like, for example, if I go buy in a low-end area, I want to make sure that I'm going and bumping my vacancy rate up. I'm bumping my bad debts expenses up. I'm bumping my repairs up, and my vandalism and theft issues and things like that. So you want to really buffer all of your major expenses if you're investing in a low-end versus a higher-end market. You know, so these are some of the things that you really learn over time, you know, when you're analyzing deals, okay? I teach, the investment strategies that I do is we do single family, we invest in multifamily value add projects, and then we invest in syndications and promissory notes. Cookie cutter type investments that we do. I just talked about all of this. Get to skip a slide, that's awesome. So today, we're going to talk about the cash flow investing goals. What's the point of doing all this in the first place? We're going to talk about how to analyze a market and how to, before you go into that market and invest, how to build your team, property management, the most important aspect, protecting yourself, investment strategies, and finding the right deal, okay? So the first thing I want to talk about is your cash flow investing goals. Who here has a budget put together for their financial situation? Okay. I'm surprised because I would expect 1% of the room to raise their hand. And I can tell you, being a CPA, that just because you make a lot of money doesn't mean you're good with money. Doesn't mean that you're good with your financial education, okay? Your financial education starts with your personal budget, your personal financial statement, and you don't know where you're going until you know what you have right now. You don't know what your goal is in investing out of state, or anywhere for that matter, without knowing what you're trying to cover with cash flow. You have to understand what your monthly expenses are on a monthly basis and what they might be coming up, what big expenses are coming up as well, before you actually start investing. So the goal, obviously, is to pay for all of these expenses and the children, if that's even possible, with cash flow. And it's not just about, if you have $6,000 a month in expenses, which is pretty much impossible living in California right now. Your mortgage is $6,000 a month probably. And if you have $6,000 a month in expenses, you want to be having $10,000 a month in cash flow coming in or above your expenses so that you can continually reinvest that money over and over and over again to keep up with inflation. Because as you guys know, the dollar has lost like 97% of its value since the enactment of the Federal Reserve. We have a big problem with that. It's going to continue that play over and over again. They're printing and printing and printing. We've seen the debt go skyrocket, in the last 10, 15 years. And so you want to be able to plan for that type of strategy, for inflation. So that means that you have to make a higher level return than what inflation is. They tell you inflation is 3%. It's not. It's much more than 3%. Yeah, it's hilarious. So, you want to be able to make sure that you're planning for that, because if you don't, you're going to be the retired person that has a fixed income that slowly gets poorer and poorer and poorer over time. Okay? So, what is this producing? The traditional investment methods, the stocks, bonds, mutual funds, CDs, all of that fun stuff, 1% of the retirees over the age of 65 are self-sustaining. 1%. That's crazy. That's a crazy statistic. So the rest are dependent on relatives or still working or charity. So keep that in mind when you're looking at what you're trying to plan for. Your financial education is the most important thing you can invest in. So you're learning one strategy here with investing in a different market and investing in out of state. You want to continue that education. Read as many books about financial education as you can. Read the entire Rich Dad Poor Dad series. That book, Rich Dad Poor Dad, even though everybody knows about it, a lot of people have read it, it made me quit my CPA firm job. I got my first deal under contract and I thought I was going to make $30,000. I made $20,000 on it, and I'm like, I quit. No more of this. As soon as I read that, I'm making the wrong kind of income. So if you, and I don't know that I would do that. Okay, I can't say that because I would do it again. But at the same time, I was looking for a way out. I knew I was making the wrong kind of income. And so you want to continually focus on passive cash flow strategies to increase your investment portfolio as much as possible. It's hard to be passive because you always have active management of your portfolio that you have to continually do. You're going to constantly be analyzing it to say, okay, what is my opportunity cost of not selling this building and reinvesting the money? What could I be making by repositioning myself in different ways? Is this the right investment for me right now? Is it going to be the right investment for me 10 years from now? The market may completely change. You want to be able to constantly be educating yourself so that you can really be financially free. That's the only way to do it, is to continue that financial education. So these guys get paid whether you make money or not, which is one of the biggest problems. Okay? They get paid whether you make money or not. And it's a shame, because you look at the education that's out there in Money Magazine, Entrepreneur Magazine, they're like, what's the new cash flow investment now? Make 3% on your money. It's like, great. That's not going to get you there. It's going to keep up with inflation. So personal budgeting. Track every single dollar that you spend. Before you start investing in anything, start tracking. Because I guarantee you don't know what you're really spending. You might write it down on a budget, but you're probably spending way more than that. I know I was when I first started doing my budget. I was like, holy crap, did I really just go spend this was in my 20s. I'm like, I just spent $500 this month on drinking? What's my problem? When I'm partying with my buddies, I'm like, this is not, I really wanted to be a girl at that time because it wasn't fair. I'm like, I want free drinks. It's not right. So, budget versus actual, okay? You want to line out what you think your budget is and then track it on a monthly basis, okay? If you don't do this continuously, how are you going to try to cover those expenses with cash flow? So it's like you get one house, maybe it's making you a couple $100 a month or something like that. Apply that to your cell phone, for example. Apply it to each expense until you slowly see the progress happening. It's little wins that happen over a period of time. Planning for larger expenditures. College is coming up, if it's even worth it to go to college anymore, which I don't think it is, if you look at the numbers. You're not guaranteed a job anymore. I personally don't believe anymore of the current education system and what it actually provides to you. So you want to be educated on the right types of things, not on what the current education system typically indoctrinates you about. So I know I'm going to go off on a tangent here. Forget it. I'm just going to leave it alone. When I ask me about it later, talk to me about it. So tracking, so you want to have your credit cards, your bank statements, and your cash. All of your different transactions, all outlined, okay? You can track them through QuickBooks or Quicken. I like Mint. Mint.com is an awesome app to use. It downloads all your transactions from your bank accounts and everything all right into your app. There are some checks that it doesn't know what it is and you have to enter your cash transactions, but you can put budgets in there. You can do a lot of different things with that to be able to track your monthly expenses very easily without having bookkeeping skill sets and things like that you have to deal with, okay? If you want, I can send you guys the budget template and a personal financial statement template so you know what your starting point is and you can start out on that. If you guys need help with that, send me an email and I'll help you guys out to get started. So, and then plan for taxes, okay? Plan because you don't want to pay them. Pay someone to do tax planning for you. I don't do taxes because I hate paying the government money. They're criminals. So, I'm going to get myself in more and more trouble. But when it comes down to taxes, if you don't plan for them, you're wasting money. If you go spend a couple $1,000s on tax planning advice from a good CPA, it's going to save you $10,000 or more, depending on your situation. If you have a W-2 with not much going on, it may be difficult. But I'm telling you right now, having that right understanding, a CPA, an attorney, they can give you great strategies on how to save your money. Okay, let's talk about the market analysis first. Who has markets? Can someone tell me some markets you're investing in right now?
Indianapolis.
Indianapolis, okay. Cleveland. Anywhere else?
Houston, Dallas.
Dallas and Houston, okay. I like Texas. I like the economics of the market. I like Indianapolis, but I got to be careful about the school districts. I was just telling you guys earlier about that.
St. Louis.
St. Louis, I like that market. You have to be very, very careful of some of the neighborhoods in that market. And, any of these markets, you want to invest in the right neighborhoods and invest your time in understanding them very, very much before you invest there. Okay, so let's talk about some of the factors. What happened in the last downturn? Was there major volatility in that market before you invest there? We're looking at, probably close to the top of the market, if not the top right now here in California. In different markets, everything can be completely different. Even though the entire United States seems to have picked up lately, you want to look and see what the volatility of that market is. I like investing in Memphis because of the lack of volatility. So I'll talk about the housing price index in a second. What happens at the local level, not even just the state level or the city level, but on the subdivision level? What's happening in those specific subdivisions? What's happening with the fluctuations in those areas? Are there people moving out? Where's the migration within the city in itself? Look at the local and state laws and the tax implications, okay? There's totally different tax implications in different markets around the country. In Tennessee, there's no state income taxes. But there's a franchise and excise tax, for example. So if you own property in your own name, there's no taxes. But if you own it in an LLC or any entity, then there's a 6% franchise and excise tax. So look and understand the tax implications and the local laws in that market. Understand the tenant-landlord laws in that market. Here in California, it's very tenant-friendly. Out in Tennessee and some of the Midwest markets, it's very landlord-friendly. You can actually kick a tenant out really, really fast if they're not paying you. And I think that's really important because the efficiency aspect is really important. Yes, you want to work with people, but you set procedures in place to make sure that it's 100% procedural and it's not emotional. I can tell you right now that if you start getting emotional when you're trying to kick a tenant out, you're going to lose more money. The very first tenant that I ever had to kick out, fun story. It made me a very hardened individual where I knocked on this lady's door myself. It was the very first time I had a tenant not paying. And I was out in the Memphis market, knocking on the door, and a 4-year-old answered the door. And I'm like, okay. And I look inside, and there's a 500-pound lady that's bedridden, sitting in the floor, and had a 2-year-old and a 4-year-old taking care of her. And I felt horrible. I was like, what can we do to help you? What was going on? What's happening with the rents? I got a horrible story about how the father was getting into drugs, and he took the disability money and was spending it, but now the money's going to the brother, so she should be okay, and everything was going to be okay. So I said, okay, no problem. We'll just catch you up 25 extra bucks a month until you catch up. She was a couple months right behind, and next month comes and there's nothing. And I gave her my personal business card with my cell phone on it to try to help her through the situation, because I'm looking at this going, this is horrible. There's a 2-year-old and a 4-year-old taking care of this lady. I come back a month later, and the sliding glass door right next to her is shattered all over the ground. And I'm like, what happened? What happened here? She's like, I don't know. I just looked up and it was like that. I'm like, now you're full of it. I knew she was lying right off the top from that point forward. So I had to evict her. Bottom of the line, it took an Isuzu Trooper, a cargo net, and firefighters to get her out to the front window of the house and take her to the hospital. And we had to have the brother come and take the kids, which was a bad situation for the whole thing. But I couldn't go and let my investor just lose money and myself lose money just having somebody just sit in a house. And of course I bought this house with a tenant in it, which be very careful about that. Make sure that when you buy a house with a tenant in it, you understand what the management company's requirements are for putting tenants in. Okay, they should make 3 times the rent. They should go through a criminal and financial background check. You should go look at their primary residence or their previous residence to make sure that they didn't destroy that if you're putting a new tenant in. Holding costs. So this can vary substantially. If you're here in California and you're rehabbing a house before you rent it out, those holding costs are going to add up substantially compared to a Midwest market with $100,000 properties, for example. Okay? And so you want to look at those holding costs and build them into your scenario, build them into your numbers. And which exit strategies? There's different exit strategies in each market as well. So understanding those exit strategies are key. Who can tell me some exit strategies that you can use? Anybody? Come on, you're scared. Sell?
Lease option.
1031?
Lease option.
Lease option? Anybody else?
Rapid.
Wrap?
Motor finance.
Rent motor finance?
Set it on fire for the insurance.
Says the attorney. I love it. So, yeah, in the low-end neighborhoods, you kind of want to sometimes, even though you don't. But yeah, all great strategies to use. I really like the seller financing strategy. I like the wrap strategy. Great strategy to use. Some properties in different markets take a longer time on the market to sell. Out here, what do you got, a month and something selling if it's priced right? Out in Tennessee, you could have 6 months if it's priced right, and it will sell. It just will take 6 months to sell. It's just a different market. They don't do, open houses like they do out here. It's a little bit different. Sometimes they do, but it's not as common as it is here. So let's talk about the local market. So the pros, you know your area, you have the contacts and the team members in place, hopefully, because you're talking with them, you're meeting with them, you're going to investment clubs like this to meet those relationships, okay? It's easier to manage because you're here. You're looking at it consistently. Cons, volatility is a big problem here. Be careful. When you're investing, make sure it's a value add in this market because you need that built-in equity to protect you if there's a downturn. It's much more competitive market. There's more risk because it's a higher dollar figure asset, okay? There's more holding costs involved, and if something happens and you have to hold it, it may be negative cash flow. It probably will be, unless you're buying all cash. So you don't have that downside protection that you have in some of the other markets around the country where your monthly payment is going to pay your debt even if you're paying a 10% private money loan. So at your cost. So be careful of those differences. Out of state, the pros is a lot of times you can have much more stable values. Not all the time. Florida is an out of state market, but it has a lot of volatility to that market. So you want to be really careful about where you're investing. But Florida can be a great market too. So they can be cash flow positive. There's a lower entry point. so you can kind of get your feet wet, especially in the beginning when you're learning. Cons, lack of familiarity. You better know that market. Call agents on the ground there, call appraisers and inspectors, different people that are, not necessarily, a real estate agent has the incentive to get you to buy a house, okay? So it's not always, granted, they want to help you, but at the same time, there's a vested interest in wanting you to buy that house because they're going to make money off of it, okay? But an outside person like an inspector or somebody else that knows the market very well doesn't necessarily have that incentive. You can go through and say, look, can I have you go tell me what you think about this neighborhood in reality? Now I've had some inspectors that live in the bougie areas that are going, no, don't ever buy this area, it's horrible. And then it really wasn't. But, you got to get people's personalities and understand them from that side too. I love my inspector. He cooks me barbecue every time I go to Memphis. It's awesome. So my property manager takes me to the Memphis games. It's perfect. So, and he buys me drinks too because he wants me to give him more properties to manage. So it's harder to develop those team members. I went through 5 property management companies before I started my own, okay? And it was very difficult. Now I have an outside management company and my own management company that I utilize that are really good, that I feel that are quality companies. They're a little bit more difficult to manage, so you have to be able to manage the managers effectively, okay? And I'll get into that in a little bit to share with you guys how to manage the managers, okay? And then there's travel costs. You got to fly there. You're not going to drive to Florida or Tennessee or Indianapolis or St. Louis. I mean, you can, but who wants to waste that much time driving? I don't. So we talked a lot about some of the pros and cons, but let's talk about how to analyze a specific area. So first thing you want to look at is the rent to price ratios in those areas. So start looking at what things rent for and what the prices of those properties were. Now you always have to incorporate renovation costs and things like that in there. So you're looking at your all-in cost compared to the price of that property. Okay, so there's a higher rent to price ratio in a lot of these lower end areas, and I'll show you guys a slide on that in a second. What is the affordability rate in that area compared to the income that they are generating in that area? So just because it's a $100,000 property and it rents for $1,000 a month, for example, doesn't mean that that is really an affordable property for the area specifically. So you want to be able to buy properties that are right in the sweet spot of affordability for that specific submarket. The volatility in the housing price index, I have a chart coming down below that I'll show you guys on that, which I think is really important to understand. So you can go to fred.com, you can go to ofheo.gov, and you will find the housing price index in pretty much every major metropolitan area of the country. So I analyzed Memphis for the last 20 years, and on average, it goes up about 4% a year. When it crashes, it goes down by 2 to 6%, depending on, this last time was about 6. So and it depends on the area that you're doing business in. Some of the lower end markets crashed a lot more than some of the middle income markets. Job growth and major employers, very, very important. You have to understand, is there one employer or is it spread out where there's multiple good employers in that area? Are you investing in an area that if that employer leaves, or if there's a state tax law change or something like that, and manufacturing leaves or something along those lines, is that going to be a problem where all of a sudden you don't have any renters? Are you in a military area where, that can ebb and flow depending on the, I guess we're always at war, right? So forget it. Never mind. That's not going to ever happen. So, state and local governments. What are they doing in that area to help the community? Are they helping business or are they hurting business in the area? Tenant landlord laws we talked about. The profitability and cash flow of those markets. Out here, you could put 20% down and not necessarily cash flow. You may still be negative on a monthly basis. Out in another market, you could put 20% down and make 10 to 15% on your money really easily. Okay, depending on cash flow. So look at the profitability of what you're actually investing in. Personally, for me, you can go and invest for appreciation, or you can invest for cash flow. I personally invest for cash flow because, to me, that's more of a sure thing than, and it's not, nothing is ever a sure thing, but it's more of a sure thing than betting that the market is going to go up. You know, and you can make a ton. You know, you can make a ton. Who's made money on appreciation? I mean, yeah, you live in California. It's awesome. But at the same time, would you think that right now is a good time to invest for appreciation in California? Probably not. I mean, if we're lucky, maybe we got a couple years left, and maybe this euphoria keeps pushing us forward. But I really believe the underlying economics of the overall California market is primarily just consumer confidence. The underlying economics don't make any sense. The unemployment rate is much higher than they report. They cut off everybody that was on unemployment for 2 years. They said, oh, you're not looking for a job anymore. I'm like, what? They didn't count the people that went from making $100,000 a year down to 50. So, and the quality of those jobs. Look at that neighborhood analysis. Go ask the local police for the crime, for the crime statistics in that area. Understand your neighborhoods. Look at the housing price index in that area. Look at the state income taxes in that area. So this is, for example, a graph of California or Los Angeles and the Memphis market, for example. You can see how stable the Memphis market is, and a lot of the Midwest markets are like that. Some of them are not, but a lot of them are. Much more stable type of market. Look at California's volatility. Yeah, you have a huge come up, but you also have a crash as well. So it just means, and I'm not saying don't invest in California, I'm saying be very careful when you're investing, the strategies that you invest in. When you are in a possible down market, if you're at the peak right now, then you better make sure that spread is a little bit better, because you want to counterbalance for that downside risk. What happens if, you know, during the 5-month flip, the market drops by 5%? Make sure that you are still in a stable position for that. Right now, in California, for example, it's really to your huge benefit to be a realtor where you can cut out those costs from having to resell that property. You know, be your own subcontractor or general contractor where you can hire your own subs on your own job. You know, do those types of things to cut out some of the extra waste in between to make those deals a little bit more profitable in this kind of a market. So look at the population growth in those areas, in the market that you're investing in. Very important to understand. Unemployment rate, is it following the overall unemployment rate of the market? Is it higher than the entire U.S.? What's going on with the unemployment in that area? What jobs are getting produced in those areas? So this is an example of the rent-to-price ratios in multiple markets throughout the country. So what this is saying is that for $1,000 a month rental, this is what you get. So here in Los Angeles, for $1,000 a month, you get a $456,000 property. Okay? So that's the rent-to-price ratio is 38 times. In Long Beach, you're looking at 415. Seattle, Washington, you're looking at 421. In Anaheim, you're looking at 375,000. Okay, for $1,000 in rent. Atlanta, Georgia, 276. Santa Ana, 303. Phoenix, 243. Nashville, 230. Yeah, please.
So you're saying with those numbers, where they're almost twice as much in California, they're still getting the same amount per month as these other areas?
So what I'm saying is that for $1,000 in rent, the price of the home is that many times. So like in Dallas, Texas, the price of the home is like 16 times the monthly rent. So you take the monthly rent times 12 times 16, and that equals where
So when you were showing before, like in California, it was for $1,000, it's like a $400,000 house, it's like $200,000, but you're still getting $1,000 a month.
Yes, exactly.
So you're making the point that
Yeah, it's different in every market. You can get these different. The lower the rent-to-price ratio, the higher the cash flow is compared to for the price you have to pay. Question here.
Are those all SFRs or those multifamilies?
I believe these are all SFRs. So and you can see like when it says 375,000 in Anaheim, you can't really buy a house for 375 in Anaheim. But a lot of things don't rent for $1,000 either in Anaheim. So unless you're getting like an apartment or something like that. So we have Memphis. You can see here is 12.26%, so 147,000 for a thousand a month in rent, which is one of the reasons I invest there. Now Detroit has its own problems. You can buy a house that might be farmland pretty soon, but at the same time, that looks like there may be value there in the future if there's infrastructure development in that market. But you don't know any of that until you really analyze the market. You hear horror stories about Detroit, about Section 8 tenants destroying the house afterwards, and then your whole house is destroyed and you lost all the rent that you just made, right? You hear horror stories about that stuff in a lot of different markets. But there may be opportunity there that you're not seeing. It's not like every area of Detroit is a horrible area. There's other areas that you can invest in that might have opportunity, but you don't know that until you analyze the market in detail, okay? So the neighborhood analysis, be very, very careful of rural areas, okay? Make sure that you are in an area that has higher foot traffic than, if you're out in the boonies somewhere, who's going to see your for rent sign? You better hope that it's online, that people are looking online. And nowadays they do. We even do pay-by-click marketing for our rentals. But I can tell you that if you are in a rural area, it's a lot harder to get that property rented, okay? Rental or owner-occupied neighborhoods. So I ran across somebody that just had a really bad experience out of Memphis, okay? They bought a brand new construction house out there where the entire neighborhood was a subdivision that was built. And it was rented to every house in the entire neighborhood was a rental. And when I drove by that house, the subdivision was already in a skeptical area of the market that I don't invest in. And the entire neighborhood, every house on the street, like half of them were half constructed, they had broken windows, and she bought this house and got destroyed by it. Because it comped out right when she bought it, when they were originally building these things, because that's when she bought it. And then it got rented to all nothing but tenants in that area instead of homeowners, and it became a big problem where there was tons of crime. It was not a great area for building anyways, in my opinion. I would have never built those houses in that area and sold them to investors in that aspect. Major crossroads in industrial areas. There's areas in different markets where literally they talk about on the other side of the bridge or the other side of the railroad tracks. It is absolutely true. Where you will drive and then you go across a railroad track and all of a sudden you're in the hood. It's like downtown Long Beach, for example, right? You got up to maybe 6th, 7th Street, you're cool, but then, and it's starting to get a little better, further up, but you go up further and you're in the hood. And you got to be really careful because that's a totally different demographic and a totally different tenant base. Foot traffic, like I mentioned, night and weekends, don't get caught like I did. I literally was like, crackhead, 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 like, oh. I was killing myself for that one. And I sold that one to my buddy too, one of my best friends. I got shit for the rest of my life for that one. Yeah, no, he's still a really good friend of mine, but I still get shit for it, so. Crime in the area, like I mentioned, look at those statistics. Do the houses look like this, where the lawns are through the roof, where the lawns are problems? Are there houses like this across the street? A lot of times, you might have a great house, but there's a couple houses in the street that are just really tore up, and that's going to really affect the quality of tenant you get. They might like the house, but if they really, I don't know about you guys, but if I saw a house like that across the street, there's no way I'm moving into that neighborhood. I don't care if it's my dream house. I'm just like, unless I find a way to get that thing torn down and make a parking lot there or, a park, then I'm not buying it, The cars look like this on the street. I remember in high school, I really wanted these things. I wanted a 64 Impala to impress my friends with. It was hilarious. Now I'm like, I see these all over Memphis. It's the funniest thing I've ever seen. But, and granted, in the low-end neighborhoods, there are not cars like this. The rims are gone. So the rims cost more than the cars, but I've seen them all over the place. So be very, very careful where you guys buy, but do look at the cars in the neighborhood. You will see very quickly, how good or bad a neighborhood is. Is there foreclosure activity in the area? Probably not right now. There's probably not a ton in the areas, depending on where you're investing. Look at the trends. Is the property viewable from the street? Is there something obstructing the property in itself? Are there bars on the windows? I don't like bars at all, mostly because my insurance company yells at me when I have bars on windows. They do not like that at all, because they look at it as you have to have proper, you need to be able to get out of the property if there's a fire. So insurance companies, a lot of times, will tell you to take the bars off the window, even if you're in a really low-end neighborhood. Now, what happens if you do that in a low-end neighborhood is you get broken into. You have problems. So that's one of the other reasons I don't invest in the hood. Okay, let's talk about the team members. The most important part. I don't care if you're buying, a junk property. I don't care what asset you're investing in. If you don't have good team members, I don't care if it's the best deal in the world or the worst deal in the world. If you don't have good team members, you're dead in the water before you start. I went through about 20 different lenders before I found people that were reliable, that I could count on every single time. And then they still ebb and flow. There's people that, there's brokers out there that, there's brokers and bankers and private lenders that are very integral to your team. But sometimes they might leave the brokerage, or they might, they might go to a different company that doesn't loan in that market anymore, or doesn't have the same guidelines that you're used to. So you have to constantly have multiple team members when you're investing, so that you understand you have options to go to, so you're not dead in the water trying to scrounge, look for a referral somewhere. So the A-Team, my favorite show when I was growing up, other than G.I. Joe. So. Brokers and bankers, like I talked about. Bankers are a direct source to the funds, right? They actually are typically the ones lending the money. Some of them keep money. Some of them keep the loans on an in-house portfolio. Some of them sell it off to Fannie Freddie, which is actually key. So, you got a question here? No? Okay. And I think it's important to understand that bankers can be very valuable. Brokers can be very valuable as well, because they have options to go out to the multiple banks to be able to get different pricing for you. Okay? Now you have to be very careful, because not all lenders are created equal. They have different point structures. So lenders make money on you in the form of points and the form of yield spread. So the bank will tell them, hey, go loan this at 4%. They'll give you a 4.5% rate and make the spread difference. Okay? And they can also make you the point. They can make the point on the front, or 2 points on the front, depending on the deal. Okay? So, and some of them have minimums. So if you have a low loan amount, sometimes they're saying, no, my minimum is $5,000 or $6,000 or whatever it is. And so you want to be careful about that aspect. I usually don't let them charge me more than a point to a point and a half. Usually I want to see a point. Private lenders are very, very key. Okay? I raise about $500,000 a month from different clients and investors for my deals. And the reason I do that is because it allows me, it gives me the ability to buy junky properties, fix them up, and renovate them, and then resell them or hold them or reposition them into hold money. Okay? So when I look at my exit strategies, I'm looking at, can I sell it? Can I sell it with seller financing? Can I sell it with bank financing? Can I hold it? If I'm going to hold it, where am I going to get the long-term money from? Is it going to be a bank loan? Is it going to be another investor's loan? How am I going to hold that property? Am I going to joint venture with somebody? But these private lenders will help you to be able to do that. It's very hard sometimes to go buy, call it a multifamily building that is trashed, and go fix it up. We just bought one that I'll show you guys later on, where the construction loan was $550,000, and we bought the thing for $149,000. You know how many people didn't want to touch that thing? We had to go to a local lender that gave us the entire $550,000 construction loan after we put in $300,000 ourselves. So, I mean, it can be very, very tricky. So sometimes private lenders, like I bought another 30 unit where I used all private money. That's it. Used the first and the second, private money on the deal. And I was able to take it down, renovate it. Basically, I bought it for $780, put a bunch of money into it. I'm into it for about 1.2. It's worth about 1.65 right now, about a year and a half later. And so, looking at those strategies, I did that with all private money, fixed it up, renovated it, increased rents, and then refinanced with the traditional lender after I was able to show a year of activity. Okay? So a lot of these lenders want to see that there's rent rolls coming in on this. Otherwise, you better have some major skin in the game yourself or bring in some joint venture partners involved. Affiliates can be very, very key. People that find you properties, people that find you capital, people that find you the resources you need to do this business. So I recommend you trying to find people and work with people, partner with people that you can have a mutually beneficial relationship with. You know, I do this a lot because I have a really good system set up. And I think it's important to understand the different ways people can bring resources to you. So, and you want to be very good at pointing out the resources that people don't even realize they have. Okay? So there's a guy here, a good friend of mine named David, that he's been coming for years to this event, to our FIBI Long Beach event, and a lot of the different FIBI events. And he was just starting out, trying to work hard to make it happen, wasn't very successful, and then he introduced me to his uncle that is, quite frankly, a baller. The guy is killing it. And he sold his mortgage business in 2006 and had a 5-year non-compete. I was like, that's genius. You know, just sell it at the perfect time of the market and get out. And you know, now I'm golfing with the guy. At some point, we're going to do a ton of business. He's starting to make a lot of money now through his business, through the referral side, just from meeting different people in the room and bringing the relationships to the right people. So you can make a ton of money just bringing relationships to people in real estate. Insurance agent, very, very key. The first time I ever had a loss on a property, I fired my insurance agent because he got me a policy. It was a DP1 policy instead of a DP3 policy, which means it was a homeowner policy, not a renter policy. I didn't know. I was green. I had no idea. It cost me $5,000. And I'm like, what makes you, I called my insurance agent and I said, what makes you think that I should have a homeowner policy when I live in California and the property's in Tennessee? And you know there's a renter in there. So I didn't have loss of rent coverage on the property, which you should have. I didn't have a builder's risk policy, which is basically if there's a fire or a peril that happens to your property, it will rebuild the property up to, so there's what's called a replacement cost coverage versus depreciated value coverage, okay? So depreciated value says you buy it for $100,000, you own it for 10 years, there's a fire, the insurance company says, hey, you own it for 10 years, all the stuff on the property is 10 years old, therefore it's only worth 75, we're giving you 75. The full replacement cost will actually rebuild the whole house, and with a builder grade option with it, it will actually go through and upgrade the property for you based on current code as well, current code upgrades. So one of my insurance agent is basically one of my largest investors. He has an awesome policy for us. We have a $2 million general liability policy, 12 months loss of rents. He covers dog bites coverage, covers domestic violence, which I'm like, how do I get sued for domestic violence? You know, just from my renter. You know, but they'll sue you for anything, and it's the attorney's cost that hurt. It's not, you know, winning or losing, it's the attorney's cost. So be very, very careful on that side, on the insurance side. He made sure I have a good policy because he invests with me. He doesn't want me to take any financial hits. So have a CPA in each market you do business in. I don't pretend to know all the tax laws in Arizona or Florida or Indianapolis or in any of the other markets that, you know, I may not invest in. So be very, very careful. Understand the tax laws and the quirks in that market that you're investing in. Okay? Attorneys, also, very important to have an attorney in each market that you invest in that can tell you the specifics about the laws in that state. You can have an attorney here do that, but at the same time, it may cost you more money in research costs, so it's much easier sometimes if you have a specific issue related to that state to have an attorney in that state. Plus, you know, there's a million different types of attorneys, right? There's real estate attorneys like Bill. There's eviction attorneys. There's a ton of different. There's liability attorneys. There's estate planning attorneys. Yeah, well, right. Yeah, that's true. That's absolutely true. So, you know, there's a lot of different specializations out there. A lot of attorneys do different strategies that are specialized in specific strategies, but a lot of them do know the liability and the structuring components of it and things like that. They should. If they don't, they're bad attorneys. You know. So I help a lot of my clients with the structuring components of their stuff, even though I probably shouldn't be telling them legal advice, because I'm not an attorney, I'm a CPA. So, realtors. There are very good and very bad realtors out there. So you want to understand and have a realtor that understands rental property in your market. Understands your market very, very well, what the segments of the market are, what properties will sell for in different markets. You want to have a good team member, and you want to have somebody that understands math. Okay? There's so many realtors out there that don't understand math. It's amazing. And I can tell you right now that if they are not taught how to analyze the property the way you want it to be analyzed, then you may have some problems with that realtor. Every single time I get a deal from somebody, specifically realtors, and it doesn't work, I break down why it didn't work and show them the numbers involved, because I want to create a different resource there. So whenever you're finding realtors, talk with them, teach them, show them how you analyze the numbers, because you may not even know something that they see as well. They may say, no, that's not possible, it's going to sell for this price, or, hey, your rehab costs are way too high because you're dealing with California numbers instead of, out-of-state numbers. So the labor costs are completely different in different markets around the country. They're not, out here you can build for $125 a square, $100 a square at a very minimum. Out there, I could probably build for $75 a square. So it's a totally different labor market, but the materials are very similar. Inspectors. Find an inspector that will go through that property with you piece by piece by piece, okay? With your contractor, and tell you what they really see. Make sure that it has written descriptions and pictures of that property. I always require my inspector to give me an estimate if they can't find the tag on the piece of equipment, or on the water heater or the HVAC system. I ask them to estimate how old they think that equipment is, okay, and how good it is, because I want to know. I want to make sure my properties, when I rent them, I want them good for 10 years at minimum. So they'll give me an estimate. The roof is plus or minus 20 years. Then I'll go get a roofer out there and they'll give me a certification on it, which of course certifications are always negative, right? Because they want to do a roof for you. So you want to make sure that you understand yourself also what it takes in some of these instances. Like an inspector can go through and tell you, hey, when you look at your roof and you see the shiny fibers coming through on the roof, it's time to replace the roof. They can tell you that, hey, this AC unit is brand new, but they never took care of it, and it looks horrible, and it's starting to rust, and there's problems with it coming up. They can tell you those things, and that really, really helps you on the renovation side substantially. Buying and selling agents, we have bird dogs on the ground out there in Tennessee that constantly bring us deals. They wholesale us deals. They make a couple $1,000. I could care less. It's like, great, bring me a deal and make me a couple $1,000. Appraisers, very, very key. So some appraisers, we were just talking about this. I had a lovely appraiser the other day that will not take MLS comps. They will not take non-MLS comps, sorry. So if you sell a property yourself, they don't count it. And the appraiser actually specifically told me over the phone, when I was trying to dispute one of his appraisals, that he will not take flip comps. And I'm like, wait, what do you mean you won't take flip comps? He's like, oh, if an investor flips a property, I'm not going to take that as a comp. I'm like, well, wait a minute. I can see maybe if it's a wholesale transaction and the work's not done right, it may not be an arm's length type transaction, but if you're fixing a property up and reselling it because you just fixed it up, how is that not a comparable sale? If you're selling it to a homeowner, an arm's length transaction, how is that a comparable sale? And so he didn't have an answer for me. Go ahead.
In some states, if you're flipping a house, you actually have to have 2 or 3 appraisals on that property if it's getting funded from a bank.
Interesting. So,
Which state is that?
In Michigan.
Oh.
interesting. So see differences in each state too. So I haven't had that issue. So we haven't had any of those types of issues. So normally we buy it, renovate it, put a tenant in, and then resell it, or we'll hold it long term as well at our cost. So we don't really have too many appraisal issues, but at the same time, every once in a while, you're like, where did you get this from? So and yeah, I mean, it depends on the state. In Michigan, maybe you have a very bad problem with that in the past, you know, so. Bird dogs we talked about, contractors, so contractors will completely steal from you, okay? Who's anybody in the contractor?
They're not raising their hands
Down in
now.
the back. He won't steal from you, but everybody else will, so. No, so, I mean, in reality, right, you better know your numbers, you better know what reality is. I don't let any of my contractors deal with any purchases of materials. I buy everything myself, because I do not trust them to buy the materials and not keep the extra, for example. One small way they steal, okay? I do not trust them to tell me that this is what you're getting and then buying a cheaper version of that, okay? I want to completely control the quality materials that I buy, okay? And in addition to that, we also go through, and when we line out all the materials costs, we show the contractor, you're going to hate me for this, but we show them 80% of the materials cost, because most contractors bid based on the materials cost. So, or the general labor bid. So we have them bid labor only, and then we do draws on that labor for as they complete that job. And we do a holdback at the end, we do a walkthrough, blue tape walkthrough, we mark everything we possibly can if there's an issue, and you know, we let a few small things go, but we show them that we're looking at each one of those little tiny things. Okay? Property managers, we're going to get into the next slide on that one. I'm going to talk about that in more detail. Financial advisors, okay? Important to have, if you don't have the skill sets, how to analyze a deal yourself, or how to protect yourself, make sure that you have the right team members on your team to show you what you should be doing and what you're maybe not doing correctly. So property management is the key, okay? We've had really, really bad managers that stolen a lot of money from us in the past. And some are very good in certain areas, and some are very bad in certain areas. And they fluctuate. Question?
Hey, just like you gave us some examples on how contractors steal, can you tell us about how property managers could steal?
Markups on repairs, if it's exuberant, for example. They will sometimes put crappy tenants in a property to get the leasing fee. And then I've seen contracts where they will put in the contract that whether it's rented or not, they get $50 a month, either way, whether it's rented. And so they don't rent it. And then they have in the contract too that if you ever want to sell that property while it's under management, then you have to pay them the commission, the 3% commission, and they let them list it. And so that's a huge conflict of interest. So you sit there with it vacant the whole time, still paying it, getting tired of having it vacant, want to go sell it, they get to list it. That's a huge conflict of interest. So there's a number of ways just like that any contractor can steal. And so I think it's really important when you're looking for, any property manager to steal. So when you're dealing with property management, you want to have a company that's very, very transparent on the accounting. Okay? That, like what we do is we have a management software called Buildium, where we upload every receipt, and we show the direct payment to the contractor every single time. We upload every single piece of material that we buy directly with the receipt directly from where we bought it from. So then that way, there's full disclosure on exactly what every little thing costs.
What do you got, that program?
Buildium property management software is what I use.
Buildium?
Buildium. There's Propertyware. There's a couple other ones out there that are decent as well. But I like Buildium. It's a good software to use. So, like I said, review those contracts. Have an attorney review those contracts. Look at the conflicts of interest within those contracts. Understand what they charge you for, okay? What are their monthly fees? So out here in California, you might find property managers that will manage your property for 4 or 5% because the rents are higher. Out of state, when you're dealing with $1,000 a month in rent or something along those lines, it's going to be 8 to 10. Something like that is normal. So it takes the same amount of labor time to manage a property there that it does here. It's just a lower rent, so usually the property management fees are a little bit higher. But it also depends on what else they're charging you for. Okay? If they charge you for every little thing in the book, then maybe their management fee should be lower. Okay? I would rather have a flat management fee where they don't charge me for anything else. You know, I don't want them charging me for evictions. I don't want them making money when they evict a client of mine, you know, because that just spews turnover. You don't want turnover. Turnover is the worst thing possible. You want them working with them, but being very stern and telling them this is how it's going to be. So get references, not only from investors, but their tenants. If they have tenants they can refer you to, ask them how well it is, how easy it is to pay, those owners, how fast they get out on their repair calls and things like that. How many properties do they manage? Okay, this may not look like a big issue, but what happens if they just took on 200 units and they're already at 200 or 300 units? That's a big change in their infrastructure. All of a sudden they've got to hire people, train people. It can be a big problem. Is there any property managers in the room? Okay, sorry. I'm some crap right now. So. Monthly statements. Who understands their monthly statements when they're getting their rents? Okay. Analyze these things in detail. Not all of them are equal. So what we do is sometimes they just show you that month only, and then you don't really remember, hey, did that tenant pay last month fully, or what was the repairs that month? I usually like to see the property on a whole for the entire year, saying, okay, I got January, February, March, April, and now I'm getting May's statement. I want to see May's statement underneath the rest of the statements because I want to see the full year so far to see how that investment is performing as a whole. Okay? Do they charge you accounting fees for these things? Do they charge you admin fees? There's a lot of little things that can be added to the mix here. Okay? What is their experience with the laws and the liability issues in that state specifically? Okay? There's different laws in that state that they have to abide by for the tenant-landlord laws. If they don't do things right, the liability is going to fall on you, guys. It's going to fall on you 100%. So be very, very careful. You have insurance in place, but it's going to cost you money. It's not going to cost, they don't care about their management fees. It's not really coming out of their pocket. Additional costs. So additional costs are, do they pay for advertising, or do they charge you for advertising? Do they charge you for, realtor commissions? They do markups on repairs. They charge you for accounting costs, admin costs. There's a million little things that they can charge you for, okay? Are they paid if it's vacant? Big conflict of interest we talked about. Markups on repairs, advertising. Getting the cheapest management company is not always the best. A lot of times I find that management companies that charge me 10% are 10 times better than someone that's willing to do 6%. Okay, because they're probably doing a lot more for that and they know their time is worth it. Proper communication is the biggest thing. It's the hugest thing. Are they communicating with you so that you can instruct them on how you want your property managed? Okay? So that is huge. If they don't tell you that, hey, that tenant didn't move, that tenant hasn't paid, and it's already like the 20th of the month, and they haven't told you already, you may have already said, look, after the 6th, I want you filing eviction. This is a brand new tenant. Usually if you have a tenant that's been there for 6 months or a year and hasn't missed a payment yet, and then they miss one, you give them a little bit more leeway. But if you have a brand new tenant coming in, and they paid the first month, and it's the second month, and it's the 6th of the month, you file on them right away. Because you want to train that tenant the right way. You don't want them automatically thinking it's okay for them to do that. So, and what I typically do is, if we're trying to work with tenants, and if they say we're going to put them on a payment plan or something like that, I make them come into the office to sign a payment plan agreement. And that's because if they're not willing to come into the office to sign the agreement, then how willing are they to catch up on their rent? How serious are they about doing that, wanting to stay in their home? So those are the types of things that the procedures that you can put in place to manage your property correctly. Management software we talked about, and that management software is really actually key because you can do marketing for your property where it syndicates to Zillow and Trulia and all those online sites. I find that most of the management softwares are a little bit lacking on the marketing side, so we go use vFlyer, for example, that syndicates to like 50 websites. We do pay-by-click marketing on Facebook. We just recently started this. It's actually working really, really well to find quality prospects. The better you are at marketing through the management software or on your own or outside of it, outside of the management software, the better quality tenants you have options for, because you have more people applying, so you can be pickier on who you're going to put in your property. Collection procedures, very, very key. Okay, what are they doing? What's the actual procedure, and is the management company communicating that with you? Okay? If they tell you that, oh yeah, we just kind of wait to hear from them, or they don't do active collecting procedures, then that's a big problem. We go through on the 5th of the month, we tell them, hey, your rent's going to be late tomorrow. By the way, we send an email out, we do a phone call. On the 6th of the month, a letter goes out, another email goes out, another phone call goes out. We literally, the 5th, the 6th, the 10th, the 15th, the 20th, we have specific days that they are calling them constantly, and if they don't communicate by the 15th of the month, that they have not communicated with us, we're filing on them. And if they're a brand new tenant, we're filing on them right away, because we don't want to deal with that headache. You have to, so success in running a real estate portfolio comes down to efficiencies. It comes down to how short of a time can you keep that, can you get that vacancy? Can you go through, and if you have to kick somebody out, or you have somebody move out, how fast can you get that thing renovated or cleaned up and back on the market and somebody in that property? So if someone gives you notice, you want to go through and start marketing that property now. Okay, you want to have all your picture documentation already ready to go. We get pictures and video and a layout of the property, all so that we can go through and market these things right away and be efficient on the marketing. So leasing procedures. Do they qualify? Do they make 3 times the rent? Have they gone through background and criminal checks? Have you looked at their previous residence? Which, if we have a tenant that is just on edge, we will go look at their house because we're not sure of that tenant. Because we want to see how are they leaving their other house. Okay? Very, very key, leasing procedures. Do you do a walkthrough inspection with those tenants? You realize that if you don't do a walkthrough inspection with those tenants and a walkout inspection, you can't charge them for damage they cause? I love it. When I was a renter, I was like, I had never had a landlord do a walkthrough inspection. I did my own inspection, but at the same time, I knew I always had the power in that relationship now. So, luckily I never left the property bad, but at the same time, you realize I'm still not giving up that power in that relationship, okay? Marketing, we talked about that, is very, very key. To syndicate to multiple sites, to get it out there constantly. You want to be posting on all those major sites consistently. Like if you're posting on Craigslist, we have multiple accounts set up where we actually have IP address scramblers, because we have people in the Philippines doing this for us and posting on Craigslist multiple times, because Craigslist does not like international people posting in your sub-market consistently like that. And so we have IP scramblers that will go through and let our guys post on these accounts multiple times in different areas. So it's interesting. Sometimes it cuts off on us and we got to go redo it again. But it works very well. You want to be at the top of that feed consistently. So how to protect yourself? Okay, I think protecting yourself is everything. Okay, you can't. Who has some ideas on ways to protect yourself? I want to get some questions in here. Let's get this going. Yeah. Insurance. Okay, proper insurance. Absolutely. Anything else?
Being in the LLC.
Say it again.
Put the beam in the LLC.
Okay, to protect yourself for liability purposes. Absolutely. What was the one over here? I missed one. Okay, everybody's scared.
Krav Maga.
Say it again.
Krav Maga.
There you go. In some of the lower-end neighborhoods, you definitely need that, for sure. So first, like I talked about, is that neighborhood analysis. You better be strapped in some of those low-end neighborhoods, okay? I can tell you that, I get really nervous, and I don't want to send my managers to some of these bad areas because it can be really, really dangerous. Market value analysis. Make sure you understand in detail that market value, okay? How do you analyze the market value of a property? And what does an appraiser look like? Can you tell us what an appraiser looks for? We have an appraiser in the room.
You're looking for comparables in the neighborhood. So,
Okay.
You can get some stuff on like Trulia, Zillow, and get a baseline of, every neighborhood has a range of values, and you're somewhere in that range. So you're looking at age, condition, size, location.
Okay. So what I've found from a standpoint where you are analyzing the value for either a sale or financing purposes, most appraisers want to stay as close to the property as possible, at the very minimum within a mile of that property, preferably within a half a mile or a quarter mile of that property, okay? In the same subdivision if all possible. And they also look out for cross streets, major cross streets, and say, okay, there's a major cross street, this neighborhood, even though it's a quarter mile away, is a completely different neighborhood than this neighborhood. They're looking at your property that may have a new roof, new plumbing and electrical, new HVAC system and fully rehabbed, versus the other comparables that are out there that they don't necessarily at all times know what those other comparables look like. You know, there are some pictures in the MLS, but sometimes there's not. There's a lack of data. So they'll go through and they'll call the other appraiser or the other listing agents to understand why that sold for that price, okay? And what she's saying is exactly right. You have a range, right? So if you are looking at houses that, you know, if you're at $500,000, you think your property is worth $500, and there's a range from, you know, $400 to $600, you're probably fine. If you're looking at a $500,000 house and it's a range from $3 to $475, you might have a problem on that appraisal. No matter if it doesn't matter if your house is the biggest house on the street. It doesn't matter if your house is the most fixed up house on the street. You may have a problem doing that because they have to justify the value in that area as a whole. Okay. Rental analysis. Okay, so you want to be calling property management companies. You want to be looking online. Zillow is a great place to go look and see what other people are listing properties for in that specific area for the square footage. We do a square footage analysis as well. So we get a rental price per square foot to compare it. But it's the same type of mentality as looking at the market value. If all of your rents are $2,000 in a neighborhood, but you have a 3,000 square foot house and everything else is 2,000 square feet, you may have a hard time getting $3,000 in rents versus $2,000. You may be only at $2,500 or $2,300 or something like that for that bigger house because they have other options to choose from in that area. And you also want to look at the how many rentals are available in that area as well. You don't want to be the highest priced property in the neighborhood, okay? And that's another good thing about having good marketing in place, is that if you have very good marketing, then you can usually demand a higher value, because they may not be looking at Zillow to see all of the properties in that neighborhood. They may just be seeing your pay-by-click marketing or your ad that's out there at one time, okay? Renovation analysis, very, very key, okay? We get a room-by-room, item-by-item breakdown of every single thing that needs to be fixed in that property. From the exterior to the HVAC systems to the plumbing and electrical to every little thing in that property, we break down in detail. Okay, and I'll show you guys one of those breakdowns in a second. Cash flow analysis. Okay, understanding what you're cash flowing is very, very key. In the very beginning, when I first got started in this business, I think it was like 2005 when I was interested in starting to learn the business. I quit my CPA firm job in 2006, and I went to an office of a mortgage broker in Manhattan Beach. I'm like, this guy's balling. He's buying Bentleys with cash. He's just killing it. And I'm like, now we all know what he's really doing. But you know, given what happened in the mortgage market. But he told me, hey, I got 5 properties for you in Denver, Colorado, that are all $1.25 million properties that my manager right now is, so my manager right now I have a property manager that leases them as corporate rentals to international people that come here, and they pay a much higher rent in these areas. And he told me that he was going to be able to get me, out of all 5 of these things, $1.25 million in cash back on the deals. And I'm sitting there going, I'm listening. You're going to give me $1.25 million cash back. I did not know that that was illegal at the time. I found out afterwards, I didn't do the deals luckily, or I would have been bankrupt right away. But what happened was, I started analyzing the cash flow. I'm like, you know what? Even with the corporate rental that he promised, they were going to be negative $6,000 a month. And I was going to be taxed 50% on the $1.25 million. And I'm like, yeah, I'm not going to do this. After the market tanked, everybody he knew lost everything. And then I found out he got a job at a bank later. like, this is how it works. It's like a revolving door, you know? So, so analyzing the cash flow on these deals, looking at your rents, minus a vacancy allowance, minus a repairs allowance, minus property taxes, insurance, property management, all of those things are very key. And on multifamily, there's even more. There can be payroll, there can be legal costs, there can be a ton of little things that can add up inside of a property. Okay, so analyzing that cash flow for that area is key. Like if I'm analyzing a property in Tennessee that's a high-end house that, is a $175,000 house out there is a high-end house, and it's got a quality tenant, I might have a 5% vacancy rate, right? But if I'm going through and buying, a low-end house that has, $700 in rents, I might want to go put, a 15% vacancy rate, for example, because or put a higher bad debts allowance in that property, because I know usually tenants that are paying those lower rents are less financially educated and are less financially stable than the higher-end tenants. Sometimes. You still got the doctors and attorneys and things like that that I've done their personal tax returns for that are some of the worst financial planners I've ever met in my life. So I'm sure the attorneys in the room are good though. So insurance coverage, make sure like we talked about, you have the right coverage in place. Okay? Make sure you understand what the problems are in that market. Talk to an insurance agent that has a ton of experience, that knows what they're doing, that can advise you correctly on what coverage you should have and what claims they've seen. Okay? Property management, do background checks and criminal checks on every property manager you do. You want to talk with. Talk to other people in the market. Go to Bigger Pockets. Go Google them. Go do as much research as you can. Meet them in person. And even then, you might still get screwed over. Because I got completely gamed up one time by a property manager. He's driving me around. I believed, he just totally had me, believing everything he had to say. Everything seemed really real, and stole $50,000 from me on a rehab. Hurts real bad when that happens. So be very careful when you do those things and don't give them control, okay? In every one of my property management agreements, I don't care what it says, I put a clause in there specifically that says that if they're not acting in my best interests and I feel they're not managing the property up to my standard, that I can get out of the contract and change management immediately with no penalty. They don't usually like that, but I don't care. If they don't want that in there, then I look at it like, look, for my management company, if they don't want to work with me, then cool, go ahead. I don't, it's $80 a month. Who cares? From a management perspective. So look at those things and make sure you understand. Okay. Inspection reports, understand those in great detail. Okay. Tenant qualifications. These are all the things that cost you money. Okay. These are all the things that can turn bad on you. Okay. Equity protection versus high leverage. So some people will go through and they buy a property, renovate it, refinance it, try to pull out as much cash as they can, okay? And it might work great, where they get out, with almost nothing into it. At the same time, there's a little bit more risk to that. You get a higher return on investment, but at the same time, there's higher risk because you have a higher loan. You might have less cash flow cushion. So when you're doing this strategy and trying to leverage as high as you can, make sure that you're making enough money on a monthly basis to where if the rents drop by 10%, because those things can happen, then you are still at least, at a very minimum, break even on that investment. Because what happens is you do not want to be in a negative cash flow situation. Okay, so at all costs, make sure you're not, by making sure that you have the right amount of cash flow coming in for that scenario. Also, if the market tanks, and you need to sell. Sometimes there's a need. Someone passes away, sickness, something like that happens, and you just don't want to deal with it. You want to be able to get out, so you don't always necessarily want to completely leverage yourself to the hilt. Okay? I'd rather bring in a joint venture partner that can go put money down than try to go and refinance and pull 100% of my cash out to where I'm leveraged as high as I can. Because it's a safer position to be in. Especially at this time of the market where there may be, issues that come up. Planning for expenditures, very, very key. Looking at those major fluctuations in in cash flow from, you know, AC units that go out, roofs that go out, making sure you plan for those items. And make sure you have all your documentation, okay? Your pictures, your video, your layouts, all of the ages of your systems in the property, okay? So here's some strategies that I use. You can wholesale and refinance, okay? That property, if you buy it from a wholesaler, you can refinance that right afterwards, or you can wholesale a property with somebody else and let them refinance it. You can buy a property with cash, bank financing. You can buy a property with seller financing too. That's pretty awesome. So I do that as many times as I possibly can, try to buy one with seller financing.
Yeah.
Yes?
When you say wholesaling, what does that mean?
So that means you buy a property that's worth $100,000 for $60,000, you go sell it for $70,000 and let someone else rehab it and fix it up and flip it, or fix it up and hold it. So that's basically what that means. I'm doing nothing to the property, and I just got a really good deal, but I can pass on that more value to someone else and let them still make a profit, but I make a quick $10,000 or whatever it is. Okay. So joint ventures with cash, you can partner with other people with cash and actually joint venture with them if you find a good deal. You can actually joint venture with a bank finance. One thing that we do is we will sell a property to an investor at our cost, have them put 20% down and get a bank loan, and then we retain 25% of the cash flow and 50% of the profit when we sell it. Now what do we do to earn that? We bought it, renovated it, tenanted it, and brought built-in equity to the table, and already had the cash flowing up front from the start with our system in place. And so we do that a lot with our investors. You can invest in multifamily in different markets around the country. You can invest in fix and flips. Those, in my opinion, you should be doing both. You should be fixing and flipping to build equity consistently, and you should also be buying and holding properties for that long-term wealth building effect, okay? And then there's syndications in different markets as well, where you can actually go through and pool your money with other investors and invest in other markets around the country where people specialize in those asset classes.
Now, you talked about seller financing. Can you give us an example of some deals that you did?
Yes. So, for example, I did one recently. This is kind of a unique deal where I had an investor that bought a property from me in 2012. Okay, and he wanted to create a promissory note out of it because he had a tenant move out after, you know, I think it was the first tenant. This actually just recently happened in late 2016. He sold it to me in mid 2016. The tenant moved out. It cost him about $2,000 in renovation costs. There was $1,000 in a security deposit as well. So it really cost him $1,000. He didn't like that. It scared him. So he said, "I want something stable." And so I said, "Okay, I am going to. I'll buy your property from you at the same price you bought it from me for, and I'll create a promissory note at 5%." for a 10-year term amortized over 30 years. And so I could have held that property and kept it and made a great spread on it, okay? But I decided to go sell it. So I sold it for about $10,000 more. And then I seller financed in that deal at 5% with $10,000 down. And I basically made the money on the difference and let him keep the seller financing. So there's strategies you could use by taking over bank financing from other people or being able to have other people finance you and want those cash flow streams. Does that make sense? And you have to understand the paperwork involved there though too. Make sure you can teach someone how they're protected, why they have a deed of trust against the property, how the promissory note works, how that paperwork works so that they're protected. That's the best way and strategy to get someone to seller finance for you. So compiling your numbers. You got your purchase price, your due diligence costs, which is attorney review, appraisals, inspections, travel, research, marketing reports, marketing, permits and utility deposits. And I'll have these slides later if you guys want as well. Overhead, surveys, environmental reports if you're buying a multifamily property, renovation costs plus your buffer. Never buy a property without having a renovation buffer in place. Ever. Ever, ever. Okay? It will burn you every time. I can guarantee it. Holding costs, closing costs, insurance, property taxes. All these are expenses that can come up that you want to be able to allocate money for and put a reserve aside for. Okay? And you build your entire cost before you do that deal. So build these into a template that you can use. So this is an example of a deal that I already sold we typically did it with, I think this one was a cash purchase, but these are the types of deals that I do. And we sell a lot of properties to international clients that live in Japan and China. We sold it with cash, bank financing, seller financing, or we do a joint venture. So this one was like a 2,000 square foot house, 3-bedroom, 2-bath, that rented for $1,075 a month. Okay, and so with vacancy management, taxes, insurance, repairs, it was netting $695 a month. Okay, not a huge cash flow deal, good middle of the road property. Okay. Someone wanted to buy it from us with bank financing. They bought it for $116, put $23,000 down. They have the rents minus the mortgage payment. They're making about $211 a month, plus the principal reduction. Your year one profits were $39.64, which is about 11% in cash flow return and about a 17% total ROI with the principal reduction on the loan. Okay? So these are the type of deals that I typically do. So someone buys it with cash, they're going to make $695 a month or $8,340 a year, which is about a 7% return on investment, 7.19. This is a seller financing deal that I do with a lot of my international clients or to self-directed retirement accounts that can't get bank financing. So I got creative and started doing seller financing after I took a weekend course on how to do seller financing, and then got some attorney advice and also got some advice from someone that specializes in seller financing as well. And so like I do this to my international clients. This is actually, I believe, the deal we did to our international client where they bought it for $118.5 instead of $116. It's basically a loan fee involved there. They put 50% down. I gave them a loan at 7% interest for 7 years. So there's a balloon at the end of 7 years because I don't want to finance long term because I don't want to take that interest rate risk, right? And there's many, if I want to sell this loan off later, it's much harder to do if I have a 30-year loan because it's harder to get a 30-year investor than a 7-year investor. Okay? So this investor is making 7.11% on their money. Okay? So what we do though, and this is what you should be doing in the documentation you should be getting on every single one of your investments, okay? Before and after pictures and video, the property layout, the comparable sales and the rents, just a full disclosure checklist. How old is your roof, all your plumbing, all your electrical, your HVAC systems? How old are all of those things? Make sure you understand all of those because they will bite you afterwards really, really hard out of cash flow, okay? And we do a full inspection report. We do a side-by-side report showing every single item in the inspection report done afterwards. And so this is the type of thing you should require of your people when you're investing out of state. Okay? We give them the rehab estimate and the financial projections, and we give them a full layout. We use a software called Punch for this, where we get a layout of the whole thing, which actually helps us with our rehab bids to estimate paint and carpet and all those other things that go along with a rehab. So we also give them comps, comparable rent and sales, and then this is an example of a disclosure checklist that we do, where we show the rehab completion date, the scope of the work, the inspection report date, the roof, you know, all of the different systems of the property we put in a lot of detail. And this is how I know it's very small for you guys in the back, but this is how we break down our renovation costs. So exterior, living room, kitchen, you know, the breakfast room, material, labor, tax, the total for every single one of them. This is all formula where we have an estimate where my rehab manager went through and said it should take you 10 minutes to go put in one outlet. That labor is times the labor rate, that's how much you should be charging for. So we can come up with estimates of what our labor should be. Then we go through and take our material costs, cut it down to 80%, and then show that to the contractor when we do what we call the dance with our contractor to get them to keep that price low. Some of the things they're all doing to you out there, sorry. I know you got your numbers, so. So renovation contracts, certificate of insurance, make sure you understand what their general liability insurance is, workers' comp, completed operations, their auto policies. You want to be able to obtain all these, especially in large rehabs. Get a material supplier identification, meaning all the people they're using as their subs or they're buying materials from, get that documentation so you can get lien waivers from them so they don't put a lien on your property because the contractor doesn't understand math and can't keep a hold of his own financial situation, okay? A lot of contractors, I had a contractor one time literally go tell me, I'm like, how do you know if you're doing okay on the money side on these things and making a profit? He said, well, if I have money in the bank, then I'm doing okay. And I'm like, oh God, it just hurts me because it was like a $500,000 rehab. And I'm like, I'm controlling everything. You are not controlling anything at all. So make sure they have their contractor's license and it's valid. W-9 forms for tax purposes. The lien waivers for all the major subs. You want to have a guarantee and a warranty for 1 year and for major defects. Time provisions. We put this in every contract, okay? We typically, if they get done early, we give them a bonus. If they take too long, we have a penalty involved. Change orders. We do not let our contractors have markups on change orders, okay? Unless it's something that I specifically ask for. But if it's something that is, involved in the property in itself, as they do the rehab, we typically don't allow them to make money on those or make a management fee on that. Make sure that you control the permits, okay? I always control the permits because what happens if you have to fire that contractor? You don't have the control anymore. You have to go down there and do a whole change and everything on your permits. You want to be able to make sure that you pull those permits and have the control there. Contractors' bonds on big deals, very important, and have a draw schedule. So it's outlined up front exactly the draw that you're doing, okay? So this is an example of a joint venture that I talked about where what we'll do is we'll have an investor go, this is a high-end house out in Tennessee, where we'll have them, they bought it for $199, they put 20% down and get a bank loan. We're looking at about $523 a month in cash flow. The investors are making about 11.8%. We take 25%, and that was at our cost. This property is worth $275,000. And we did a joint venture, so we brought a substantial amount of built-in equity to the table. I left the green granite countertops. I'm sorry, it was ugly, but it was expensive, so I left it. So I figure we'll do that when we sell it. So this is an example of a multifamily we did. It's already sold, another investor owns it, where we actually had to almost rebuild this entire property, okay? We went and gutted everything. By the time we bought it, there was actually tenants living in this property with mold all over the walls in the bathrooms. I'm like, everybody out. Get out right away. They all got eviction notices saying they have to move. I said we would pay for their moving costs. We had other multifamilies available that they could move into, but it was a big liability concern. We had to do the foundation, all the plumbing, all the electrical, the roof. When we went to go replace the doors and windows, all of the framing on the doors and windows had to be completely replaced. This thing was built in 1912. Last time I'll ever buy something that old. It was not fun on the rehab, but at the same time, now it's beautiful. Like, sweet, okay. So this is another building. This is the one I told you about that we bought for $149,000. This is what it looked like previously. And now, at an 8 cap, we're into it for about $900 after all costs and the construction and everything. It's worth about $1.735 million now. It was a giant risk, but it paid off. So this is what it looks like now. We did brand new everything involved, including washers and dryers, all of it, and did a full gated access, everything on this property. So here's an example of how your flow chart should go when you're actually acquiring an asset, okay? So you get your property leads coming in either through pay-by-click marketing, through wholesalers, through mailers. You have them coming in, you're analyzing a ton of these leads. And then you have your initial market value and profitability analysis when those deals come in, okay? Then you go do your due diligence and your neighborhood analysis, your preliminary rehab analysis, your walkthrough of this property, and your rental analysis. You start making offers and trying to get things under contract, and then you do your final renovation bids after you get it under contract and do a more detailed bid than your first bid was. Okay? You look at what your exit strategies are, what your profitability is going to be if you wanted to sell it, or if you wanted to hold it, with your insurance, get your insurance in place, get your inspections done, your final market value analysis on that deal. Okay? Line up your funding. Get your funding, which is another it's harder than actually lining up your funding, is getting the people to actually send the money. Okay? So a lot of times you better have some reserves aside in case somebody falls out or have another lender available in a pinch. And then you do your renovation and tenanting, and then I have my little fireman there with the cash flow thing that I stole off the internet. So, and before you close, get your title insurance, your general liability insurance with your vacancy and rental policies, and understand what perils are covered. Your prorations, taxes are done correctly on your HUD closing statement, okay? Make sure your property taxes, insurance, your security deposits are on there, your rental prorations are on there, your proof of funds and your funding all lined up. Do your HUD review, HUD closing statement, make sure the deed of trust is correct, and they're actually putting it in your name. I've seen errors like this before when it goes into the wrong name because there's a typo from the closing attorney. Closing documents, make sure we review those in detail. Get your earnest money deposits all lined out on there. Your keys. That you saw that multifamily building that we did that was built in 1912? We had a ring of keys. It was like 80 keys. You know how hard that was to find out the right keys to every unit? And it was cold as hell in the winter out there. Our managers were like, I hate you for this. And I'm like, you got a bonus, I'm sorry. He's sitting there like freezing, trying to get all these different keys in multiple units. Renovation payments, make sure those are lined out correctly. And then you have your promissory loans and notes and lender documents all lined out and everything as well for the proper closing. Okay? Know your costs on managing these things, okay? After you close and everything's going, you want to be able to actively manage these managers, okay? So, understand what your mortgage payments are, your taxes and insurance impounds, okay? Understand what the property management costs are, what your vacancy rate is in the area, when you should be increasing rents in a property. You want to be analyzing the rents on an annual basis to see, should I be raising rents in this area? What are your miscellaneous expenses that exist? And analyze these as you go through, okay? Managing the property managers, reviewing the monthly statements, very, very key, okay? Tracking those tenant collections and asking questions. I can tell you, if you don't get an email back from a manager, you email them again and again and again, or call them, get on their butt until they answer you. Let them know that you're not going to go away until you get your answer, okay? Because they will sometimes try to not answer your questions and just ignore you. Keep up on those repair invoices. If you have, a dishwasher go out and you knew that it went out a year ago, then what happened? Did the tenant cause that, where you should charge the tenant? If you didn't know that, if you weren't keeping up on what repairs were actually happening, it might cost you money when really a tenant should be paying for that. Okay? Obtain all of the tenant documentation for your own records. If you have to move management companies, it's key. Okay? Notify the management about how you want the eviction procedures to go. Okay? And then tell them up front what you expect. That proper communication is very, very key. Okay? Review your numbers continually. Look at the tax and legal implications. And then keep an eye on that market. Understand what's happening in the market overall. Okay? All these things are very important to manage your investment correctly. So finding the right investment for you is very, very key because it depends on your personal situation, okay? You want to know what your risk tolerance level is. If you think you're going to be going crazy every month being worried about your property, don't invest out of state. Understand that about yourself beforehand. Are you the type of person that's going to be neurotic, just constantly worried? You don't want to be doing that. Determine how much time do you have. Do you want to be a flipper? Do you want to be active or passive in these markets? What return are you comfortable with? Are you going for active level return on investment where there's a totally big difference between being an active investor where you're flipping and buying these yourself versus being passive and having it done for you, okay? Do you understand how you're protected? Do you have the capabilities of using bank leverage in the first place? How much cash resources do you have for your investments? And do you have time or other relationships that can help you when you're investing? So cash and bank financing is not the only two assets that you can utilize when you're investing. Your time and your relationships and your skill sets are huge benefits that you can use to help other people invest and make money with. What's your current cash flow goal and your monthly expenses? We talked and harped on that in the very beginning, I understand. And develop a plan. Really put the plan in place before you start investing. Okay? Know that I need $10,000 a month in monthly cash flow to be financially free. And I'm going to get there in this. Line out your 10-year plan, your 5-year, your 3-year, your 2-year, your 1-year, and say, how am I going to get there through those steps? If my 10-year plan is $10,000 a month, how many properties and how much cash flow do you need to have in order to get there? And break it, go backwards. Okay? So, I love this slide because really, people don't take action. Most of the time, because they asked someone else's opinion that's in a worse financial situation than themselves. And you don't go ask your broke uncle for financial advice, okay? I have a couple of broke uncles. I would never ask them for financial advice. I love them dearly, but they're not financial savvy guys. You don't go ask those guys for that advice, okay? So for yourself, if you guys have seen this slide before, I apologize. I love this slide. But what are your next steps? And the first step is to develop a strategic financial plan for yourself, okay? Know what your current financial situation is, what your expenses are. Plan for your taxes and find ways to reduce them because that's your biggest expense in life, okay? Other than kids, which I found out just recently. So, set up the right legal structures for yourself and find ways of increasing your income. I don't care if it's selling stuff on eBay. Get rid of the crap in your house. You can find more money for investing. I can guarantee it. Set the right financial and life goals for yourself. You want to be able to have that clearly defined aim, okay? You want to say, this is my 10-year plan, and be obsessed with it until you get there. I can tell you how many times my wife has said that I'm obsessed with real estate and I need to shut up. Because I love this stuff and I can't stop thinking about it. Even if I'm at home, I'm sitting there thinking about, okay, what's this next strategy I got to put in place? Get educated, and I really believe financial education is the key, and repetition is very key. So the more you read, the more you learn, it trains your mind daily and the ways to think about your life and the ways to actually constantly improve and get better, okay? I have some books and tapes if you guys want them. I have like Think and Grow Rich. I have The Law of Success in 16 Lessons by Napoleon Hill. I have How to Win Friends and Influence People by Dale Carnegie. Rich Dad, Poor Dad. If you guys want any of those books, just email me and I'll send you guys copies. So I really believe also that associating with the right people is important. Okay? Look at who your friends are. We all heard the saying, your net worth is equal to your the average of your 5 best friends, or whatever it is, right? And I believe that to be 100% true. If you look at who you're hanging out with, realize what are the things they talk about. The wealthy people, middle class, and poor people talk and think about different strategies. And the more you hang out with the wealthy people that are talking about, hey, you know this new investment strategy that I just found out about? Check this out. This is really cool. Look how much money this makes. Or, or the wealthy person is saying, you know what? If you're not in shape, if you're not, taking care of yourself, you're going to be, you're not going to be as good of an investor. It's the life and mentality changes that they teach you along the way. Okay. Versus the poor people might be talking about, the next sports game on. What's happening right there, which is fine. You have to have time for those things, of course. But at the same time, you want to be thinking like the rich people, constantly developing the resources that they have as well, developing those friendships, okay? And I really believe the more you achieve in your life, the happier you'll be. I don't know if it really comes down to fighting that temporary satisfaction of sitting on the couch and getting through that pain of getting up and doing something, okay? It's like if you go to the gym and you work out, it's really hard to get your butt to the gym. Once you've finished it, you feel great, right? That one day you go to the gym. If you go there for 5 months or 6 months, you feel amazing. You feel amazing. Think about the long-term satisfaction you get from that versus the initial pain you had to go through to do that. Okay? The more you fight through that initial pain, the happier you're going to be with every aspect of your life. Not just considering, money in general. Money is not the goal. The money creates the life you want. Okay? Which I'm still self-employed, so don't listen to me. So, for investors, by investors, Long Beach. The next events we have coming up, like I mentioned, we have how to find probate deals. We have a brunch and learn on investing in promissory notes, and we have our South Bay event on creating long-term sustainable cash flow through promissory notes. Okay, so if you thought this presentation was valuable, please feel free to come. If you hate me and hate the presentation, then that's okay too. I'm not that personable. I'm a CPA, so that's my excuse. So thank you guys very much. I appreciate your guys' time today. If you guys have any questions, feel free to ask, and we can talk afterwards as well. So I know it's late, so I'll stop the presentation now. Thank you guys very much.